Now, the jobs data came out on Friday, and it was really bad. It was a lot worse than people expected, and it in fact printed something, as the thumbnail you just clicked on showed, that we haven't seen since basically COVID. And what I mean is that what happened was the jobs data for June was revised downwards to the point where it was actually a negative print. And the jobs data is revised twice. There's an initial revision, and then there's a second revision. And after the second revision, that's it. And what happened was, after the second revision for June's data, the number was actually a negative print. And it was above a positive print even up till the second print. And so what happened was, it was revised down another 27,000, producing a negative print. Now here's the thing. We have not seen a monthly negative print on the jobs data since the COVID pandemic. And that's a very significant data point. We can't ignore that. That's not just something out of the blue. And hence the red alert. It's backed by data. This is something we can't just sweep under the carpet and pretend that, it was an anomaly, which I'll show you why it's not an anomaly, and that everything's hunky-dory. No, that's not the case. The case is, in 5 years, which is half a decade, we have done something that we haven't seen, and that is print a monthly negative jobs number. And so keep that in mind, because this is a signal, okay, that you can't ignore, and that is going to flip the market psychology from bad news being good, meaning bad news, so Fed's going to cut rates and that's good for the stock market, to a situation where now the market psychology flips to bad news actually being bad news. So if we continue forward and look at the jobs data for basically the year in entirety, you'll see what I was talking about earlier. There's a first revision, okay, after the initial jobs number comes out, and then there's a second revision that comes out, and that's it, right? That's the final reading. And so as I was saying earlier, right, this is amazing. So for both May and June, right, the initial reading was that we created about 140,000, 150,000 jobs, or in combination, almost 300,000 jobs were created in those 2 months. Initially is what was reported and what everybody was trading off of. Then after the first revision, it was actually increased, right, for the month of May, but decreased for the month of June by a tremendously huge amount for June. And then what happened was the second revision, which just came out on Friday, was that May actually was revised down to just 19,000. And June was revised down to a negative number, which is what I was just talking about. And this has translated into the difference from the original reading of almost 300,000, 280,000 jobs just vanished, right, in 2 months. This is a significant downward revision. So in other words, everything we thought, how good the job market was, how resilient the economy is, and all the good stuff that we've been hearing, and why the stock market should just be going up, 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 has actually been revised downwards. And not just by a little bit, by almost the entirety of it, right? We are talking about a complete negation of, and in fact, a negative negation of jobs that we thought were created in those 2 months. And if we look at what happened for the month of July, for which the jobs number came out, which was just 22,000, and we'll talk about that, that came in way under than what we were thinking. So we're talking about multiple consecutive months, right, of deteriorating jobs, and not just slowly deteriorating, but an acceleration in the deterioration. Now, let's just talk about the latest jobs print, which just came out on Friday. The expectation, right, the expectation for August data was that we would create 75,000 jobs. That was the highest, right, in the distribution of estimates. And what happened was the jobs came in under 25,000, right? This is where the jobs came in. So this huge gap represents the miss, okay? We were expecting this much, we got this much. And what this chart is showing you is a standard deviation. So how far off were we from, how big was the miss is basically what we're talking about here. And we're talking about a 6 sigma. So this really poor, well below expectations August jobs data for the month of August missed just not by a little bit, but by a huge amount. And that's the initial print. Remember, what we've been seeing in the other months is that after the initial print, there's 2 revisions, and the revisions are negative. It's been negative revisions all the time by the time the second and final revision comes out. And so if you believe that this tiny 20-something thousand job print for the month of August is gonna be revised downwards, you join me in that camp, because that's basically what has been going on for the entire year. If you actually go into 2024, that also has been going on the entire year of 2024 almost, which I'm going to show you in a bit. Now, everything I talk about here is data backed, so I'm just spewing data. I'm not trying to like manipulate the data into some, kind of analysis. You can do the analysis yourself. I'm just presenting to you the hard cold facts of what is going on with the jobs market, which is a huge component of the economy. Now, if we look at the 3-month average, okay, so now we're taking 3 months worth of data, and we do this so we can smooth out, right, the little like jitteries over here. We'll take an average over 3 months to smooth it out. And what you'll see is that ever since January, we've basically been in a huge downward trend, right? We're now in August, so we're already past the first 3 quarters of the year. And what you'll notice is that this has just been a deteriorating job market for throughout the year of 2025. And the reason why this data is significant is because what happens is you'll get an imbalance such as what we're seeing now. So again, another first since April 2021, okay? So kind of like the COVID days. Here's another data point. What we're looking at is that now the US has more unemployed people than new job openings. Okay, and that's a significant barrier to cross. The last time across that was when we had that huge spike because of the lockdowns. And we're just making that cross now. And that means that there is the sustainability is now being diminished, because if there are more job seekers than there are open jobs, then that only means the unemployment is just going to keep rising now, because there's just not enough jobs compared to the number of people looking for jobs. So that number, once that gap starts to widen, so will the unemployment. So all the factors that I'm bringing up to you are telling you that there is now, without a doubt, there was a lot of debate before whether or not the jobs market and the unemployment part of the economy was still strong and things are still going well. Well, now I think we can safely say that that is off the table, right? There is no more doubt in our minds, and there shouldn't be, based on this data that I've shown you. And the data is not just one data point. It's over the entire year of 2025 now, with the revisions for the finality of the data, that there is no question that the job market is deteriorating. And that means everybody is at risk here. You, me, okay, I don't know, I don't have a job, but everybody who has a job at a company needs to understand this, right? This is going on, right? It is the beginning signs of a big downturn that's coming our way. And why do I say big? Well, let me explain to you what history has shown. Now, on September 9, what's going to happen is the BLS, right, Department of Labor, is going to come out and do an annual revision. Okay, so I've been showing you like monthly revisions of what happens every month. They revise once, they revise twice, and then that's a final monthly data. Well, they do the same for the entire year, right? They'll do a revision for the entire year, and they do that once. And that's happening on September 9, next week. And what that means is they're going to come out and say, oh yeah, for the entire year since last year to now, this many jobs, and this is a Goldman Sachs estimate, which is they're going to revise down from 500,000 to 1 million jobs, just go poof, never existed, right? And the last year in 2024 they did that. They actually revised down almost 800,000 jobs, right? Last year. And so this year it might be up to 1 million jobs. Now think about this, right? Think about it. It's definitely going to be a downward revision, just because I already showed you for all the months of 2025, it has been nothing but downward revisions pretty much. So the number is definitely going to be a downward revision. The question is just how big of a downward revision are we going to get on September 9th when the annual revision happens? Make no mistake, this will be a big number, and it'll be a market moving number. It's going to weigh on the psychology of all of us, of people. It'll make headlines when they come out and say, oh yeah, by the way, in the last year, we actually had to basically delete the existence of up to 1 million jobs. Think about that. And what's worse is it's not just the last year, because in 2024, they revised down already back then, a couple of years ago, over 800,000 jobs. So we're going to add to that 800,000, perhaps up to 1 million jobs also the following year that just disappeared. This is, I don't think people are understanding the gravity of this data. We've all felt, okay, we've all felt that the job market is tightening. It's harder to find a job, especially if you're younger and coming out of college. There's all this talk about AI taking jobs, and there's all of this anecdotal talk you see on X, on social media, people talking about it, even on jobs platforms like LinkedIn. You hear it, but we weren't seeing it in the data, and the fundamentals and people who were always being the perma bulls were saying the economy is strong, and that's why stock market's going to keep going up, and we're entering a new bull market, which I kind of tried to debunk, right, in my last episode about people like Tom Lee saying we're going into a new bull market here, which I completely disagree with based on the data that I'm showing you. Well, now we're seeing the data coming out to support basically what we've been feeling for the past year and so on. And that's actually, in a good way, good, because it validates what we're seeing in the real world, right? But bad in the sense that reality is going to get worse if the data is showing that turn, right, happening in recent times. Now, if we continue forward here, now, if we look further into the data, it's actually really bad, right? Because if you look into the last month of August, which was, as I said, came in low, what jobs were created, okay, were part-time jobs, okay, working less than 35 hours. That was what was positive, okay? What was negative was full-time jobs. So people with real, I don't want to say real jobs, but, 9 to 5, like full-time jobs, negative, right? Lost. The only reason why it became positive was because of part-time jobs. We're talking about people doing delivery and Uber Eats, that kind of, part-time job is what grew, whereas actual real full-time jobs, in my opinion, are the full-time jobs, right? Falling off the cliff. So this is, if you look within the data itself, it's not showing you that the distribution is something to be happy about. It's actually a further deterioration in the internals of the broad numbers that we are looking at. And why is this bad? Now, when we look at the historical data, whenever we start having a rollover, so the blue is job openings, right? So whenever, or violet, whenever we have this rollover of job openings, right, which we recently had here and we had earlier, we have had recessions, right? We've always had them. These gray bars are recessions. Even in COVID, when we had that spike down because of the shutdowns, right? We had that brief COVID recession. Now here we are. We've had this rollover, but where's the recession, right? And this is what I mean. There was none, technically speaking, and the stock market just kept going up and up and up and up, right? This is a huge anomaly, This doesn't happen, right? As I've shown you, it always is when the job market rolls over, we have a recession. That's just physics, okay? But what happened to physics? Well, COVID happened. And what do I mean by COVID? COVID to me, yes, there was that disease, of course, but what it really represented in the financial world was the banks, the central banks, going cuckoo. They pressed the nuclear button, right? The red button to launch the equivalent of a financial nuclear bomb. They pressed it. And what was that? They engaged in a crazy, ridiculous, dangerous amount of money printing, which, to be fair, they were scared. We didn't know if the world was going to end, right? Honestly, there was a point where we didn't know, right? It could be sayonara, that's it, right? This virus kills everybody on the planet type of thing. There was that moment for a bit. And so they just launched into a crazy amount of money printing. They being not just the Fed, but the European and central banks and all around the world printed amounts of money that we have never seen before, right? In essence, the nuclear bomb, they pressed the button. And when they pressed that button, a couple of things happened. One is inflation finally started to tick up, right? And so we saw we had that whole inflation thing that we went through, transitory inflation, but then it became real. Then they had to raise interest rates to battle the inflation. That happened, right? Even in Japan, a place that had no inflation. They were dealing with deflation since the 1980s. Even Japan had inflation, right? Because of the crazy amount of money printing they did. The other thing that happened, besides inflation, was it masked the recession. It was like somebody having a shock accident and then you pumping them with an absurd amount of opium or opiate painkillers so that they're just drugged out and it's like, and they don't, that's basically the economy, right? They shot the patient with so much opium that the patient's just comatose, right? And so that's why we haven't seen a recession, because of the absurd amount of money printing going on. Literally, they printed money that went into your back pockets. That's never happened. It's print to your pocket money that they did during COVID with the stimmy checks, as one example. And when that happened, the recession was kind of like, again, like the patient getting injected, right? So we didn't have the recession. But all things will come to an end. This can't happen forever. And the danger is, did we inject too much opium into the patient that there's going to be an overdose situation? You're going to have to do the ER stuff? That's what we're worried about, right? Because if you look at what's going on with the sovereign debt markets, that's what's telling you. We'll talk about that in a second. But basically, we haven't had a recession. There's no gray bar here because we printed at a certain amount of money. That printing is just... So meanwhile, jobs, right, has been going, the real world has been going down, but the stock market's going up because of all the printing, right? But eventually, like I said, all things come to an end. This is not something that's going to go up and away into infinity, no matter how much I like Toy Story. Now, talking about inflation, if we're looking about what's happening with inflation, we're seeing this, a clear uptick ever since the past, couple of months going into 2025. And we are all thinking that the tariffs are going to fuel this further because of the lag, which I've talked about in my previous episodes. Now, why is this something I want to bring up here? Well, if you look at basically what happened in the 70s when we had stagflation, in the 70s what happened was, if you look at the blue line, is we had that big uptake. They raised interest rates and battled it down. And then what happened was they got, complacent. They didn't keep the interest rates up. And inflation went up even higher, right? The second inflation mountain happened. And then that's when they needed the 20% interest rates, right? Which finally slayed the inflation dragon. And here we are, right? Here we are tracking this. With tariffs, this might go up, right? And if that happens, we may have a repeat of stagflation, which we saw in the 1970s. And stagflation is basically a recession with high inflation, right? The worst of both worlds. And we're looking at the economy sputtering now, definitely with the jobs market, all right, which is the biggest indicator of a coming recession, along with the yield inversions and all that other stuff, which I'm not going to get into. At the same time, we're looking at a potential spike in inflation because it's picking up here. And we're supposed to see more coming in from tariffs because of the lag effect from all the hoarding that the companies did earlier in the year to offset the tariff-induced higher prices for their input costs. So, unlike the 70s though, and this is why this dangerous situation here, unlike the 70s, okay, we had the COVID thing, which did what? It introduced an absurd amount of money printing, which did what? Put a lot of countries into sovereign debt with out of control spending and trade imbalances. With the US approaching $40 trillion of debt. That was not the case in the 70s, and why they could raise interest rates up to 20%. Today, we have a crazy amount, okay? A crazy amount of debt. So that caps how much they can raise interest rates should inflation shoot up. Now everybody wants to say we got to have to do what Paul Volcker did and do that can't happen today because once Powell leaves, Trump is going to put in somebody who's going to listen to him. And what Trump and Bessent want is to lower interest rates so they can pay off the debt with a low interest rate on the short-term yield curve. Okay, but that is not what's going to happen if the inflation rate continues to go up. They're going to have to manage both things, which is a very difficult thing to do in stagflation, and why I think we're in danger of something that's actually much worse than the 70s, because going into the stagflation, we're in a much worse scenario, particularly with the national sovereign debt of the United States. Now, remember in the last episode, I was talking about this 100-year channel line, right? So this was the Great Depression crash, right? 1929, going all the way up to 2025. So this is a very long term, all right, channel. And at the up side of the channel, at the top, is this resistance line, which we've had a few touches, right? This was the year 2000 bust, and then in 2022 we touched it, and then last year before the tariff crash, we touched it, and we're touching it again. The reason I bring this up here is because, on Friday, basically, before the jobs data came out, I shared this on Discord, so that 100-year line is this yellow line in this chart, okay? I was saying, look, we're right at that line again. We're right at that line, okay? That means either you think that we're going to finally break through a 100-year, right? So something we haven't done in 100 years, we're going to finally do on Friday, or we're not, right? And I was telling him, watch out here, because this is a big inflection point, potentially. And so what happened later in the day is we tried to go up a little bit, and then we just got batted down, right? So the 100-year line, we just couldn't go above it, and we got smacked down pretty hard as soon as the market opened on Friday with the jobs data, which everybody thought was market's going to go up because jobs bad, Fed going to cut rates, so good for stock market, Well, that did not actually happen with the initial reaction, and we did recover a little bit later in the day, but the initial reaction is very important. Like I told you with the NVIDIA in the last episode, right? We saw the initial reaction with NVIDIA, even with the jobs, with NVIDIA had the beat in earnings. The stock initially went down by a lot, right, which it then recovered. But that initial reaction tells you the positioning of the machines, right, the algos and what they've programmed in. And that tells you what, even if it recovers, what's going to happen later. Similar to here, we had a bad jobs number, which means Fed going to cut rates, and it should have just gone up, but it didn't. And so this is an initial tell, right, of what happened. And to show you, that move was a very significant move, right? This is on the hourly, okay? So this is the S&P futures on the hourly, and we had a massive 1 hour, and went actually further down, okay, of a candle. And we haven't seen this kind of a drop in the S&P, right? And I looked. So that drop, right, what you see over here, we haven't had that big of an hourly drop going all the way back into May. We have to go back into April of this year to see something that was that significant. So that is a big tell, right? You can't and the market recovered after, but just look at that initial drop. That tells you that something has changed. And as I said earlier, what has changed is the market had been moving in this forever upwards, forever Tom Lee bull market, up, to infinity and beyond mentality, where good news was good news and even bad news was good news. So it was just good news no matter what the news was. Psychology and way of thinking that the herd had. And that's why it kept going up. But Friday was different because bad news came out, and what should have been good news, and the initial reaction should have just been shooting up for up to kingdom come, was actually a huge red candle that we haven't seen since basically the tariff crash, right, on the hourly. And so that's telling you something. To me, what it told me was the market psychology, the herd, has shifted. That's what it looks like when the sharks finally pull the trigger onto, the dip buying retail people. It's enough, right? Bad news actually now is bad news. It's not good news anymore. It's actually bad news. And when that happens, that's the sign of, I'm not saying this is the top, but it's definitely a sign of a top, right? And that the psychology is changing, and now the herd's going to catch up to the changed psychology, and we're going to go mosey on down here. Now, I just want to bring up the chart I showed earlier, why I was thinking this was going to happen. And I told you in the last episode that the S&P 500 was making new highs, whereas the NASDAQ was not, right? And so this, to me, was a clear signal of a move away, a diversification away from the tech-heavy NASDAQ, right? And to me, that says, well, what does a NASDAQ represent? It represents hot money, right? That's the money, quick chasing for profits, and they're going out of it. That tells you that liquidity is shifting away. And if you look at hot money, and this is why it's dangerous right now, basically the zero DTEs are at record levels, and we're actually at this point now, right? We're actually at the point where the NASDAQ, almost 80% of total volume, okay, is zero DTEs. 80% of daily volume is zero DTEs. This is crazy. Now we're going to, as we do in this channel, not get academic and technical, we keep it Sesame Street here and keep it simple. Zero DTE is basically hot money. What it is people just going in and out of the stock market for the day, right? I'm in the morning and I'm out by the end of the day. That's not investing. Investing is like, I'm going to invest in you, and then we're going to see you work for months and years, and then, I'm going to collect a return on my investment. Okay? Going in and out every day is day trading. Okay? That's trading, that's speculative, that's going casino style. What that chart is saying, and not only going in and out every day, you're doing it on margin. So you're borrowing money, right? You're borrowing money to then bet on the slot machine, and you're going to, find out by the end of the day. That is now 80% for the Qs, for the NASDAQ, of all volume. Think about that. 80% of volume every day is just people going in and out, right? Gambling with borrowed money leverage on the. We have never been in this situation before. Ever since the COVID check, everybody is now a guru options trader on the stock market, and we have to thank platforms like Robinhood to make it easy to do options trading and go on margin and borrow money. So now it's like easy to do it and accessible for everybody to do it. So now everybody's a guru professional options trader, talking about deltas and gammas and fading this and doing. My man, we are setting ourselves up for a massive implosion of all these guru traders, all right, who have never seen, many of which just started after COVID 5 years ago, they've never seen an actual recession or a crash, right, get completely wasted. That always happens, right? There's always people who've never traded, think they're God's gift to the world, and nothing can, and then like they get just killed, and their trading account goes to zero. And then rinse and repeat with a new generation of young people who've never done it. Young, not age, but young, just never traded before. And then they get wiped out, right? This cycle continues over and over. And what we're seeing this cycle, but the problem I have with this cycle is it's just the size of it, right? The size of it is scary to me. I don't like that. Also, in my previous episode, I said after the Jackson Hole, what happens is there's a pop and it goes down, pop and goes down. Well, we had the pop. And I think now we're going to have the goes down part. And will that happen in this incarnation of the Jackson Hole? I don't know, looks like it, right? It's going to happen every other time, and it looks like it's going to happen. Let's see what happens here. But so far, that seems to be what's happening. The other chart I showed you before was what's happening with the S&P 500 in the long term compared to the Nikkei. Now, this is based on market cap as percent of GDP. We've hit a 210,000. Okay, I'm not going to harp on this because I talked about it in the last episode, but the Nikkei never reached that, right? It went up to 150. We're at 210. And what happened after the Nikkei was basically decades of going nowhere. And the reason why I bring this up here is because I did not show this in the last time, but I saw this, and this is basically in the 70s when we had stagflation, which I think is what we're heading into. And basically the stock market just went nowhere, right, for that whole decade. And we could be heading into that nowhere land for the next decade. So what that means, like, okay, we're going up here, and we might correct down. Last time in the 70s, that was almost a 50% drop. We could drop 50% here, do a little squiggle and drop 50%, and then go up, and then do this, right? And this is actually what I think. I mean, we could just keep going down and crash like, the doomsayers say. And, I'm not necessarily a doomsayer. We're going, everybody's going to, collapse. We could. That's not my base case, though. And that's because we got money printers. My base case is we're probably just going to go nowhere, right? Like we did in the 70s. But that doesn't mean we won't have, 50% drop is huge, right? You could get easily wiped out, and we could go up again and then drop another 50, 40, 30%, right? That could happen. Point here is up and away new bull market is not my base case. If you want to go with the bull tards and all the forever perma bulls, you should be watching this channel. There are better ways to lose money by watching them. All right. So what happened ever since the jobs data came out on Friday was we're pretty much now, okay, guaranteed a rate cut in September, right? 92%, with an 8% saying we might get a 50%, right? 50% rate cut, 50%, 50 basis points rate cut. But pretty much September, we're going to get a rate cut. And, that what happened is in the 10-year Treasury, which is what the mortgage rate follows, 10 and 30 years, collapsed. So everyone's saying, hey, mortgage rate's going to go down, right? But let me just remind you. So when the Fed actually cut, the 10-year just skyrocketed, right? It went down into the cut, which is what it's doing now, meaning, woohoo, they're going to cut, so everything goes down. But then when they actually did the cut, which is happening in a couple of weeks from now, it went up. So could we continue to go down in yields and then at the actual cut just go up? That could very well happen, right? That could very well happen. And mortgage rates may go back up. Now, I've spent an entire episode talking about why mortgage rates going down is actually going to make the housing market price collapse, right? Because of pent-up demand of people not being able to sell their house because they don't want to go into a new mortgage with such high interest rates, so they're just holding. But then once the mortgage is going, they're going to just the dam's going to unleash, and we're going to have a huge amount of transactions increasing from now, which is almost nothing, and prices are going to come down, right? And cause the housing market to crash. And that's a huge thing because everybody's sense of wealth is locked into their house. And if prices come down by like 20% or more, even up to 40% in some areas, like what happened in 07, 08, you're going to feel a lot poorer. You're going to spend a lot less. It's going to add to the recession and the contraction of the economy because nobody's spending. And as we know, consumer spending is 70, 80% of the entire economy. So the mortgage rates going down is actually a good thing for people who can finally buy houses. A bad thing for the economy because you're going to feel a lot poorer when your main, home equity is disintegrating. But then we're not even sure if mortgage rates are going to go down because the last time the Fed cut, and when they cut, it was a jumbo cut the last time, right? In August last year. It was 50 basis point cut. That just skyrocketed yields. Why? Because, well, we're so much in debt. The country is. And they didn't like that. So every time, and I'll bring this, I showed this the last time, but every time the Fed starts cutting, right, we've had recessions. I'm not going to harp on this, right? You can go back to 1955. Every time we've cut, right? Every time we've cut. And why they cut? Because things aren't looking good. They're too late, Powell. Right? So they're cutting now because employment is not looking good again. Guess what follows? The recession. I'm telling you guys, we are going in for a recession and likely stagflation because inflation is not going to go down. Now, if we look at what happened in 2020, we'll see that nothing has gone down but up for all of these countries. And what are all these funny looking colors? They are the long-term yields for all these countries. Basically, US, Germany, Japan, UK, and actually more than just these countries. What happened here? Why was it going down until 2020, and then suddenly after 2020, all of a sudden yields, which is interest rates, long term, which none of the central banks control, have gone up? And this is what I was talking about earlier. What happened in 2020 was everybody, all the central banks hit the red nuclear button and printed money to the point where they printed so much that the entire world's confidence in the debt system of those countries has collapsed. And now the world is demanding higher interest rates, right, if they're going to buy their debt, because they don't trust that it's ever going to be paid off anymore. So because they don't trust that the government's going to be paid, and that debt that they're going to buy might not ever get paid off. So if you want me to buy that, I'm going to ask you to pay me more then. And how are you going to pay me more? Well, I demand a higher interest rate from you. And that's basically what's going on. It is not just the US. It is the entire developed Western financial system. And this is that danger. Now, this is the end game, right? This is run away. And you're going to just have an implosion of the financial system. You're going to have to create a new one. And that's why you want to have instruments to help you move from the old system to the new system, whatever the new system they create is. And I'm not going to, but dude, this is really bad, right? Credit card debt, student loan debt. I mean, the consumer is tanking at the same time. The jobs market is tanking at the same time. Housing prices is tanking. The consumer is just going to feel really bad, right? And spending is going to go down, which is going to funnel in to the recession, because spending is, like I said, 70-80% of the economy. This is all just raveling down, 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 right? Be prepared for this. Don't stick your head like an ostrich into the ground and just get sandblasted when this happens. You can prepare for this right now. And one of the ways that I've been preparing for it, as you know if you've been watching my channel, is buying a lot of gold. Look at gold's just skyrocketed right now. As you know, I sold my physical gold like a couple of months ago, and it has gone nowhere. But also, you know, if you've been watching this channel, a couple of weeks ago, I got into GDX, which is a gold miners, and that has skyrocketed even higher than gold. And I actually liquidated my GDX because I'm trading in and out of it, and for a good, almost like a 9% profit in a couple of weeks. And this is my entire net worth, so that's a huge amount for me to move 9% of your entire net worth in a couple of weeks. And I think there's more to go, but I'm just being careful here with, if a potential crash, these things are going to get liquidated. High-performing assets such as gold and GDX could get liquidated to hit margin call requests so you don't go bankrupt. That's the risk I'm playing around, so that's why I'm very nimble around GDX, which you can easily, it's very liquid, trade around, unlike physical gold bars. Eventually I'm going to go back into my physical gold bars when we get into the end game, because of the debt that I just showed you of all the Western countries. And what's interesting is our man over here in El Salvador, now he's famous for buying Bitcoin, right? Interestingly, he's starting to buy gold, right? So that tells you a sign, right? That tells you things are getting hairy out there. The other thing that you need to know is that even though gold spot, which is the actual price of the physical metal in the spot market, you can see, I was watching here, like, I sold out because I wasn't sure, is this going to go up or down? I thought it might go down, it might go up. I was like, look, this trading range, I'm going to go into cash, and gold will show me what it went up. That's why I went, but I wanted the GDX, right? And it's treated me well. But look at what happened with the ETF, GLD, primarily. It hasn't really accumulated. Now, normally they track each other, right? But it is so far behind. So once the ETF is forced to go here, you're going to see the next rocket stage boost up in gold. All right, that's eventually coming. Nobody can say the timing. No, I don't have a crystal ball. All I'm saying is this, the data is this. There's a huge discrepancy, and it's likely going to, resolve itself. When and how, look, again, I'm not a fortune teller. That's up to some guru out there who pretends to know the future. If you want to follow those guys, go ahead, right? I'm just telling you facts so that you understand the factual data of what's going on, and then you can make your own decisions on what to do based on your setup. And finally, I'll show this. I keep showing this again. Look, this is the GDX gold ratio. It's broken out. Now it's broken out even higher. I think this has a huge amount to go to catch up to gold where it was earlier back in the early 2000s, and why I'm playing GDX, eventually get back into gold. So that ends this episode, and I just want you to understand to look at the data. Don't get married to a thesis or a belief of the market. Don't be a perma bear or perma bull. Look, I'm a huge gold bug and a gold bull, but even I sold, right? Because I wasn't sure about where the market was going to go, and I needed the data to tell me what my next move was, and it showed me, and I profited from it with GDX. So here's my point, right? Just go with the data. Don't try to be the fortune teller, or don't listen to fortune tellers out there, right? They'll be right once every while, but that's just a losing strategy. Is follow the data, know when the risks are, go in and out when it makes sense, let the market dictate to you what happens. And most importantly, if this information is helpful for you, give it a like and a subscribe and share it so that other people can get access to this knowledge for them to, make their own decisions as well. If you've been watching until this end, thank you so much for your support. If you've liked and subscribed, thank you so much for your support of this channel. I hope this has been helpful and informative for you, and that we continue to grow together. Having said that, have a great week, and I'll see you in the next episode. Peace.